Over here on the left, I have an example of what would be called a high probability iron condor. And they call it high probability because it's covering a relatively wide span of what the market may move. So if you look here where this bend is right here, this is the 143 strike for IWM. And up here, this is the 155 strike. So I actually have a $12 or 12-point range for this Iron Condor, where if price was to stay within that range, and even a slightly outside that range because of the credit I receive, if we were to stay within that 12-point range, this trade could make $155. Now, the drawback to this trade is that if I was to hover over the risk on this trade, and as I'm hovering my mouse on the screen on this broker platform, if you look in this box over here on the left, when I'm hovering, the blue text is showing you what the price would be at expiration for this trade, and the pink text would tell you what the price is for current profit and loss if price got down to that level. Now, the current price right now as I'm making this video is 149.33. All we're looking for is for the market to churn around in a range of less than 12 points, hopefully, so that time could go by and we can make money. Now, the big thing about Iron Condors is they make money every day based on time value going away on the options that you sold. So this theta value right here, this $4.23 currently, is how much this trade's going to make per day based on the time value going away. And down here, and let me expand this one for a moment. If I was to come down here on this platform, I can advance the date to show you that your profit and loss, and keep an eye on your profit and loss over here, and keep an eye on the theta value, because each day that goes by, as long as price stays centered, your theta value will increase, and then your profit and loss will increase based on that theta value, because each day you make some money. So let's just advance this a couple days and watch what happens. Ideally, we're looking for our Iron Condor trade. We're putting it on and we're anticipating that price is going to go sideways. Now, it's okay if price goes up a little or down a little. It's actually fine if it goes up a little and then comes back down a little. It's actually ideal for that to happen because we want to burn off some time. And while the market doesn't necessarily stay perfectly still, it will gyrate around a good part of the time where it stays within a range. So could we find a stock or an index that will stay within a range of, let's say, 12 points in this case, and could we make enough money often enough to offset the risk? And that's the big key right here, is the offset the risk. Because on this trade, let me bring the date back here a second. On this trade, if I'm trying to make $155, but I'm risking, if I come over here, my risk is $845. Let's just say that I would make the full amount or lose the full amount each time. How many times would I have to win for that 155 to offset the times that I lose? Let's say we were doing 10 trades. If I lost one time, $845, but 9 times I made $155, would I be making money? So that's what we're going to look at in the next video. See you then.